In the previous topic, we talked about the basics of technical analysis, which introduced you to reading charts of prices, volumes, and moving averages. While very popular in India, it is also important for you to understand the more fundamental aspects of a company's operations. By fundamental, we mean how the financial characteristics of firms, such as revenues, solvency, profitability, and debt, will impact their earnings, and in turn, how those earnings will impact prices. Said another way, we now move from the supply and demand characteristics that affect prices, which is what we saw in those charts, to what creates value. Let's look at notions of value next. One of the oldest notions of value is book value. Book value refers to the value at which an asset is carried on a company's balance sheet. Think of things like land, buildings, machinery, equipment needed to make stuff. A second notion of liquidation value. This too is a number that represents what price you can receive for a company's assets if you were to liquidate them in a fire sale. Think a bit more. Rather than dump those assets at rock bottom prices, what might it cost to replace them as they are, slightly used, worn out, dings, dents? Replacement value is such a notion, the price at which assets roughly similar to what you own can be purchased. Think further still. What would you do as an investor trader if the price of a company's equity was less than the replacement value of the assets the company owns? Wouldn't you be tempted to buy up all of this equity, even borrow money to do it, then turn around and sell the assets at replacement value and turn a tidy profit? Private equity, PE firms, do things like this every now and again, but I hope you see more generally how notions of value that we've discussed so far might help you think about generating some returns. More generally, let's talk about comparables valuation. What you've seen above is termed valuation by comparables. You take two notions of value, compare them with each other, and arrive at a sense of what some group of assets is possibly worth. The numerator term in this ratio comparison is usually always price or market value. Instead of book or liquidation or replacement in the denominator, we can also compare this stock market value directly with items reported on the profit loss statement of any company. Among the most popular such metrics is the price earnings ratio, or the ratio of price per share to earnings per share. A PE, price to earnings ratio, of 15 would mean that the market price is suggesting that each rupee of earnings is worth about 15 rupees in price. A higher or a lower price earnings ratio would imply that shares are expensive or cheaper. Note too that this ratio can be calculated at the company level, an industry level, or even at the level of an entire market. So what are the caveats to doing this earnings type of comparison? We all know that companies play games when it comes to reporting their earnings to investors. So which earnings should we use to identify the denominator of that PE ratio? Earnings from the most recent year, or estimates of earnings from next year, or even further out into the future, known as forward earnings? The latter will show a lower PE ratio than the former if the current price is used in the numerator, and lower is good, right? Moreover, earnings of companies will fluctuate with the business cycle, would they not? Higher in good times, lower in bad economic times. So should we average out the earnings over the last 5 to 10 years? And should we adjust them for inflation? Let me leave you with one chart as you ponder these coming attractions. Figure 1 shows you price earnings ratios with all these adjustments for the US and for emerging market economies over the last couple of decades. I find it fascinating how the two of them converged during the 2008-2009 crisis, only to diverge again. In times of crises, everything becomes correlated, doesn't it? Stay tuned. Our next topic in this module continues our discussion further. Come back for more.